Hi, Sabine Stovall with the Wealth Planning Company. You are watching Sabine Has Something to Say. I'm going to focus today on midterm elections and the impact that they have on the economy. We have a midterm election coming up in November. Historically, the U.S. stock market is almost always bumpy in the months leading up to midterm elections, especially in the summer and early fall. The main reason for that is uncertainty. Midterms decide which party controls Congress, and that directly affects taxes, spending, and regulation that hit businesses' bottom lines. When investors don't know who is going to win, they get nervous and markets swing more. Let me show you. This is the first of a series of graphics that I'm going to share today that were published by Capital Group. You can find them on the Capital Group website. As you can see here, if you remove midterm election years from market performance, the gray line in the graphic, you see that performance is really impressive, especially when compared to the midterm election years, that bottom blue line. The good news is that markets traditionally bounce back very strong in the year following the midterm election. So if we were to remove the year following midterm elections from stock market performance, we see an average of 7.8%. Whereas the average return following a midterm election is 15.4%. So if we can withstand the few more months of market volatility, history tells us that we may be rewarded in the year that follows. And this is true regardless of the outcome of the midterm election, whether we end up with a unified government, a unified Congress with the president and the other party, or a split Congress. Investment returns historically have been very positive following midterm elections. You might be watching this and you might think, okay, Sabine, intellectually, I understand, historically, statistically, all of these things may happen, but it doesn't feel good right now. And if you're paying attention, there's a lot of reason to not feel good right now. But what typically happens when consumer sentiment is very low is that the market prices that in, which creates really attractive opportunities moving forward. In other words, the worse people feel about the market, the more likely it is to do very well in the months following. It's counterintuitive, but it's historically true. And don't forget how resilient we are, individually and as an economy. We have experienced a lot of crises before. Just over the past 40 years, look at how many devastating things we have survived. Wars, recessions, a pandemic. We are a resilient people and we have a resilient economy. I know that it might be uncomfortable right now. If you take a look at your portfolio, if you pay attention to the news, there's a lot of reason for discomfort. But know that the most successful investors are the ones that stay the course, remain invested, and allow time and the power of compound interest to work on your portfolio. And as always, if you have any specific questions, please don't hesitate to call us. We at the Wealth Planning Company would love to be your advisors to ensure that your portfolio is properly diversified so that you are positioned to withstand the current and upcoming volatility and to make sure that you are in the best position to succeed, given your risk tolerance, time horizon, and accumulation goals. We love our clients. We love this business, and we would love to help. Sabine Stovall with the Wealth Planning Company. Until next time.